Good morning, everyone. Welcome to Municipal Green Bond Disclosure, Investor Guidance and Issuer Perspective. This is a webinar produced by the California Debt and Investment Advisory Commission. I'm Robert Berry, the Executive Director here at CDAC. For about the next 90 minutes, our presenters are going to be talking about issuing labeled debt, specifically green bonds, why they may meet your financing objectives, but most importantly, what you should expect in the form of initial and continuing disclosure to justify affixing the green label to your bonds. But how are these disclosure expectations formed? In part, they're formed by the common federal securities laws that prohibit untrue statements or material omissions and are designed to ensure that investors are provided information relevant to their investment decision. So some say this may be the baseline expectation, but the bar for what constitutes good or even exemplary green bond disclosure is rising. Regulatory interest in this area is increasing, but what is really pulling the bar higher is the market. Demand for green bonds has grown, and as the market has grown and developed, many investors have become more discriminating in their purchases and require their investment decisions to be informed by information regarding the environmental impact of the financed projects that's more complete, quantified, and substantiated. So as an issuer, what should you be prepared to disclose to meet these investor expectations? What is the market research and what does it tell us? Well, in May 2023, to begin to answer these questions, the California Green Bond Market Development Committee released a paper, Recommended Approach to Municipal Green Bond Disclosure. This paper aimed to collect disclosure expectations across a variety of credits and investor types and assemble them in a framework intended as guidance to issuers. Today, you'll hear from several members of the subcommittee directly involved in developing the paper. They'll discuss the paper's findings and guidance, but also provide you with insight based on their perspectives as to why the guidance can vary and depend on the type of investor evaluating your debt. We'll also get a reaction from a very experienced green bond issuer that has dealt with many of the disclosure matters that are unique to green bonds. What you'll not hear today is a recipe on issuing green bonds, but rather recommendations from very experienced professionals that when processed through and factored for your individual circumstances can position your green bond issue advantageously in the market. Now, obviously, there are political forces that frequently intersect with public finance decision-making, along with the practical issues of financial and administrative capacity. At CDAC, we recognize that issuing labeled debt, and green bonds in particular, may not be the right decision for every agency. But as a finance strategy, if it's a finance strategy in your toolkit now, or you're considering it for the future, we want to help prepare you to take advantage of this growing and evolving market opportunity. That is CDAC's simple motivation for bringing this program to you today. Now, I know you're all anxious to get started, but please allow me to review just a few quick housekeeping items. So the slides and the recommended disclosure approaches paper, and also the biographies of our speakers today, are available in the link in the handouts section of your GoToWebinar control panel. We've also posted these things to our website as well. Use your questions box in the control panel to submit questions anytime during the program. We have a planned time at the end of the program for a Q&A session. We have a captioning service that is accessible through the linked address in the chat section of the control panel. If you participate in 70% of the webinar, we'll send you a certificate of attendance in just a couple of weeks. And then also in a couple of weeks, we'll make a full replay of the program available in CDAC's education portal. We'll send you a notification when it is plugged into the portal and ready for viewing. And then lastly, if you have technical problems, GoToWebinar can help you at the link or the number on the screen. Now I'd like to welcome and introduce our 5 very distinguished presenters. First, we have Kevin Savali. Kevin is a shareholder at Stradling, Yaka, Carlson, and Roth, and for more than 26 years, he has represented a large number of public sector clients in a variety of financings. Kevin is a member of the California Green Bond Market Development Committee and was a member of the subcommittee to produce Recommended Approach to Municipal Green Bond Disclosure. Joining Kevin is Ruth Ducret. Ruth is a senior research analyst at Breckenridge Capital Advisors, where she performs municipal credit analysis. Ruth also currently serves on the advisory council of the Green Bond Principles and Social Bond Principles of the International Capital Market Association. Ruth was also a member of the subcommittee that produced the disclosure guidance. Then next, we have Robert Haney, Treasury Manager of the East Bay Municipal Utility District. Robbie is responsible for the oversight of the district's debt management, investment management, and rate planning operations. And if you did not know, East Bay Municipal Utility District is one of the most experienced green bond issuers in California. We also welcome Emily Robert. Emily is a vice president with PIMCO. She's a credit research analyst on the PIMCO Municipal Credit Research Team, where she covers a portfolio of municipal credits from around the US. Emily also leads the integration of ESG factors across PIMCO's municipal strategies. Along with Kevin and Ruth and Emily, Emily was also on the Disclosure Approach Subcommittee. Then lastly, we welcome our lead presenter and moderator, Raul Amezcua. Raul is a senior managing director with Ramirez and Company, and with 32 years of experience in California public finance, Raul currently leads the firm's California team. Raul has been a long-standing member of the California Green Bond Market Development Committee, where he led the subcommittee efforts on the recommended green bond disclosure approaches. At this point, I'll turn the program over to you, Raul.
Fantastic. Thank you, Robert. So I thought I would start this morning by wishing everybody a good morning, saying thank you for joining our webinar, and hopefully you'll get some good information and takeaways from it. The goals of the webinar are to understand why green bonds continue to be an important topic of discussion in the municipal bond market. 2, to recognize the potential benefits of issuing the green bonds. Thirdly, to appreciate that there are different types of investors that invest in green bonds. They're not all the same, and we're going to talk a lot about that topic in this webinar. And fourthly, and perhaps most important, is to know what additional disclosure should be in your POS to have a green bond investor interested in investing in your bonds. So on the next slide, I will just start the webinar here with maybe one of 4 survey questions that we have for you all. And I know not everybody in the audience is an issuer. Some of you are industry participants, so everyone feel free to participate. But we do have our first question just to set the tone. What is the biggest hurdle in issuing green bonds in your opinion? Your options are no resources to produce the needed disclosure. Secondly, waiting to see a pricing benefit, the so-called greenium. Thirdly, concerns about additional continuing disclosure requirements. Or fourthly, you've actually participated or issued in a green bond issue in the past. So we'll give you about a minute to put your vote in. We're tabulating the results. And the survey results, pretty spread out. Concerns about a continuing disclosure is about a third. About a quarter of the audience has participated in a green bond issue, and a quarter is waiting to see a pricing benefit. And the lack of resources is a little bit more than 1 out of every 7 participants. So with that as good background as to what concerns are of folks when they're issuing green bonds, we'll go to the next slide. So Robert touched upon this, but we recently released a recommended approach to municipal green bond disclosure. It was put together by the State Treasurer's California Green Bond Market Development Committee. And I think if you don't have access to that paper, it is in the CDAC website, so you can get that from that website. But the reason that it was put together was we were, as part of the committee, Kevin and I are part of the California Green Bond Market Development Committee. It's been around for a couple of years, and we're thinking about what is a good deliverable. Like, we're committee, we're talking about green bonds. Usually our discussion is about disclosure, what disclosure is needed in the OS, and related matters. And we thought, well, what's a good deliverable? And so we thought a good deliverable would be to produce the paper that we produced, the recommended approach to municipal green bond disclosure, written largely by municipal market investors and specifically for US municipal market issuers. So there are other frameworks out there. We're going to touch on them. We're going to talk about them in this webinar, but they're really not written specifically for the municipal bond market issuer. And I like to say some of those other frameworks, those other resources are long, they use small font, they're hard to read, they take a while and effort to read, and we decided let's make ours really, really easy. So our paper is basically 14 pages using 14 font size. So we wanted to make it really easy for the municipal bond issuers to use it as a resources. Go take a look, take a few minutes, and then decide, can I provide this type of disclosure? That's really the goal of the paper. If we go to the next slide. These were our subcommittee members. We had 10 representatives or representatives from 10 major municipal bond investors, including Emily Robert and Ruth Ducret, who are both on this webinar. So thank you to the both of them, as well as to the entire committee. Kevin Savali was also part of it for helping put that paper together, and to the three of them for joining me today on this webinar. The next slide, please. So very important, when we set out to write this paper, we thought, well, what are we going to talk about? Because there's so much we could talk about, right? And kind of like, you know, the topic of ESG is a hot topic right now, but we decided to be very focused on our paper and not address the broader ESG risk disclosure, which is related but different to green bond disclosure. So green bond disclosure simply means if you're issuing bonds to finance a project that has an environmental benefit, whether you label it green or not, that's what we call a green bond. And kind of an important example, I was working on a transaction earlier this year where the OS was not, the issue was not labeled green. And during the pricing, we had an investor call and said, I would love to buy your bonds for my green bond fund, but I'm missing this piece of information. Is it available somewhere? If it is, then I can buy your bond and put it in my green bond fund. Again, the bond was not labeled green, but the green bond investors sought out that investment because it met their own internal criteria, and they were just missing some information that we were able to refer them to the issuer's website. They got the information, they bought the bonds. So again, very broad, and this is such an important point of this webinar. All we're talking about when we talk about green bonds is any bond where the proceeds are used to fund a project that has an environmental benefit. It's that simple. That's really the definition that we worked from. The next slide. So our committee actually took the time, and there's about 10, 11, 12 members. We each assigned ourselves about, I forget what it was, 15 OSs. And we went and we looked at 15 official statements for issuers that had labeled their bonds green bonds. And then we got back together as a committee and said, okay, what were the good examples? Are there issuers out there that had very good green bond disclosure that would help the green bond investor invest in their bonds pretty easily? And were there examples that maybe were not complete, that investors wanted more information, needed more information? What did those look like? So out of the hundreds of green bonds that we OSs that we reviewed, a few kind of rose to the top as examples of a model, if you will, of good green bond disclosure. So this right here is just lifted, cut and pasted from an official statement. And I know there's a lot of words here, but the important words are there emboldened, where it says the district's aim should be towards including projects that best meet one or more of the identified criteria. It goes on to say the district considers projects that are designed to meet one or more of the following criteria to be green projects, and they list the criteria. So that was deemed a model example of an OS disclosure because it shows that the district in this instance was very thoughtful of what they were doing. They talk about an identified criteria, and if you go to the next slide, they actually took the time to produce in an appendix in their official statement, I forget if it was about 3 or 4 pages, a table. This is just a little subset, but they went through each component where they expected to spend the proceeds of the bonds. And there were maybe 20 components, and identify what is that project. Just give me a few words on what the environmental benefit is. Tell me what green bond criteria you used to deem it to be a green bond, and how much of the bond proceeds are going to be used for that project. So in this instance, the issuer laid out the criteria that they were going to use, and then just reference it here in the third column, which criteria is met by this component. So the investors really appreciated that the issuer took the time to set up the criteria, to describe how they were going to deem the bond to produce an environmental benefit, and laid out the detail of all the different components that would be benefiting from the bond proceeds and how they tie to that criteria. Okay, so that is really kind of the crux of what investors are looking for, that thoughtful approach to what are we doing with the proceeds? And just give me a sense of what the environmental benefit is of the project. If you go to the next slide, we found a lot of examples like this one. And this again is just cut and pasted from an official statement, and this is basically it. There was nothing more other than the OS cover said this is a green bond, and then when you went to the green section of the official statement, it basically said this. You know, the bonds are green due to the proceeds being used to finance sustainable water, wastewater management projects that contribute to the development of sustainable infrastructure for clean water and or drinking water and wastewater treatment, period. So clearly this project should be deemed green. There's definitely an environmental benefit, but what was missing is that next step, that level of discussion where you tell the investor, okay, this is how we deemed this project, these proceeds will fund project or projects that have an environmental benefit. Based on what? Based on what criteria? What was your thought process? What's the detail of the projects? Okay, that is exactly what was missing from this example. I'm sure this project would be deemed green, but it was missing that added step of disclosure that investors really need, which is what we're talking about today. If we go to the next topic, the next slide. I'll turn it over to Ruth Ducret for her introduction.
Thanks, Raul, and thanks for having me on this webinar. And if you could turn the slide, please. So my name is Ruth Ducret. I'm a senior analyst here at Breckenridge Capital Advisors. We are based out of Boston, also have an office in San Diego, and I thought I'd take a few moments to talk about the firm and then how we approach green bonds and ESG. So we were founded in 1993. We're 100% independently owned, and we have about 44 billion in assets under management, with the vast majority, about 36 billion, in municipal tax-exempt bonds. We are a certified B Corp, which means that we every year give away 1% of our gross revenues to charity. And we're focused on customized separate accounts. So we're not a fund, but rather separately managed accounts that are focused on fixed income, dividend income, and sustainable investing strategies. And that's a picture of me in the bottom right-hand corner when I was about 7 years younger. So next slide, please. So in terms of how we think about ESG, there are a number of different kinds of investors out there, and our approach has always been, over the last 10 years, to think about ESG and how we can integrate it with our traditional credit approach to investment management. So we view environmental, social, and governance risks, incorporating those risks into our traditional credit analysis as a way to minimize risk over a longer term investment horizon. So we believe that, not only can you get information about a credit from an audit or from projections, but also from non-financial information like climate change, like social factors that maybe aren't so quantitatively driven, but that ultimately impact the risk of your investment over the longer term. So we take this approach in terms of our ESG research focus, in terms of credit risk management. We apply it to all the sectors that all of the investment types that we cover, so corporates, municipals, agency, MBS and CMBS and ABS, that's asset-backed securities. But in terms of municipals, what we're really focused on is analyzing, as I said, this sort of non-financial data and how it can drive investment decisions over the longer term. Next slide, please. So the way we factor our ESG approach into our methodology is that we've created for each of the sectors, the municipal sectors that we cover, we have developed our own proprietary frameworks. So these frameworks are based on both quantitative and qualitative metrics that can be both scalable and repeatable. So we want to make sure that the factors that we look at on the environmental side, on the social side, and governance can be repeated across the entire municipal market for every single credit that we're looking at. And so each of the frameworks that we've developed in-house, I cover hospitals, for example, so I worked on our hospital framework. Each of them focus a bit more or less depending on the sector in terms of the E, the S, and the G. So our hospital frameworks focus more on the social on social metrics, while our water sewer might cover more of the environmental side. But on all of our frameworks, it incorporates things like climate risk, adaptation efforts, mitigation efforts. And what we do is that for each credit that we're looking at, we assign a sustainability rating from S1 to S4. The S1 is sort of the best in class, and S4 is the sort of a more weaker performer. And depending on the rating that we assign based on these ES and G metrics, that can influence our traditional credit decisions. So if we were to assign a rating of AA-, but an issuer has a sort of disproportionate risk to let's say flooding, for example, we might bring that rating down to an A+, and that is the traditional credit rating is what our traders use to execute on their trades and find pricing discovery. But in terms of how we look at green bonds specifically, green bonds do not qualify or disqualify an issuer from going into one of our separately managed accounts. That isn't sort of a line in the sand that we draw, but rather when we look at green bonds, it certainly indicates often a higher, a sort of more sophisticated approach, a more thoughtful approach, and it could ultimately impact our sustainability ratings depending on the amount of disclosure, particularly not just on the use of proceeds, but on the general information that's given on the issuer as a whole. So as an integrated ESG investor, what I'm thinking about mostly is not only what specifically are those proceeds being used for, but rather how does that fit in with an issuer's overall thinking and planning in terms of sustainability efforts. So next slide. And I think I'll turn it over to Emily at this point. Thank you.
Great, thanks Ruth, and hi everyone, I'm Emily Robert with PIMCO. If you're not familiar with PIMCO, we are a $1.8 trillion assets under management global company. About a third of those assets are invested in sustainable strategies. So ESG and looking at green bonds and sustainability bonds is a big part of what we do. We have about 70 billion in municipal assets, with about 11–12% of those are in sustainable strategies. And so when we're looking at green bonds, if we can go to the next slide. I know Raul is going to get a little more into detail about some of the best practices that were recommended in this paper we put together as a group with the California Treasurer's Office. But I wanted to just mention, so internally, and within PIMCO, when we're looking at a green bond or a social or sustainability bond, we are looking at the information that's being provided. We are looking to see if a second party opinion has been procured and what that opinion is stating about the bond issue. But then we also do our own internal assessment. And I'll get into that in a little more detail on the next slide, but we're thinking about how do these bonds fit in with, as Ruth just alluded to, thinking about your overall strategy as an issuer, how you might be thinking about climate change or working on other environmental issues across the municipality or university or whatever type of issuer it is, and what sort of impact these projects are expected to have. A few things that we found really helpful. One, I think Raul had a great example earlier of where when the use of, it's just a use of proceeds paragraph in the official statement that doesn't have a lot of detail. It's not always very helpful to investors because we really don't have a good sense of what you're using the bond proceeds for. We're not just taking green bonds at face value that has that label attached to it, but want to really have an understanding of what types of projects are being funded, and recognizing that not every issuer has a good sense of what the expected impact would be. That can be a lot of extra data that you're collecting if you're trying to really measure impact, but at least expected outcomes or sort of how this fits into your overall strategy as an issuer and how you're approaching sustainability. Being California issuers, I know most of the people on this call are in California. It could be not just your own local sustainability strategy, but part of the statewide commitment to move to net zero by 2045. So there's already sort of a natural story and framework within which California issuers are working under as part of meeting those overall state goals. And then I know a lot of issuers have their own local goals as well. And so understanding where these green bonds fit in can be really helpful in seeing, as Ruth mentioned, what you're doing overall as an issuer on climate change, and that can feed into the credit profile, as well as just understanding the expected impact of these particular bonds. And then we do also look, for the UN Sustainable Development Goals. If you're not familiar with that, I think there's 17 or 18 goals that were established by the UN for the entire world to work on to meet by 2030. And so there's often a lot of mapping of those goals with green bonds and different projects that you might be working under. And so some of those are around climate change or around hunger or poverty that may not be as applicable to the green bond space. And then last point on here of just obtaining that independent verification. It can be really helpful if you do have a second party opinion. One, especially if there's investors who are looking from Europe or from other parts of the world that might be requiring those verifications for regulatory purposes. And so that's part of why there's sometimes extra demand for that, or there have been at times talk about a premium within the taxable space because those are focused on investors that are in other markets that might be really looking for that external label. We do look at any bonds that are issued. It can be with a green bond label or without, or with a self-label, but there is seen as there being extra transparency, disclosure, and benefits if you are seeking out that second party opinion. And there's just a couple of examples on here of some of the other types of disclosure that can be helpful. So this first one I think is kind of similar to the example that Raul showed, where you have the eligible products listed and kind of specifics about each type of project that you're funding within your official statement. We recognize that often a lot of different projects get bundled together. The second example here, We're focusing today on ICMA, the International Capital Markets Association, and their principles for issuing green bonds. But there's also a climate bonds initiative that does a certification that's focused on really meeting the goals of the Paris Agreement, so that 1.5 degrees warming, trying to stay below that. So this was a particular housing finance agency that was trying to meet those goals and talked about how the projects that they were funding would be in line with meeting those targets. So if you're looking at any additional places, LEED certified, things like that, that can be really helpful to discuss as well. Next slide, please. So this just gives you a little more detail about what we're looking for specifically when we're doing our own internal assessment. So the first is what we call strategic fit. So this is thinking about, as I mentioned, how does this fit into your overarching strategy? If you have a climate action plan or you have a sustainability strategy as an organization, where does this fit in? Are you funding parts of the goals of that strategy? And we recognize too, not everyone's going to have one of those strategies, and especially for smaller issuers, there might not be the resources to put something like that together. I know, in that first survey question, continuing disclosure requirements was one of the concerns that individuals raised. And so it's not that you have to have this, but something might score higher or be seen as more beneficial. But someone might start at, maybe you start small and then you can kind of work up to, if you do a second green bond issuance, you add more to it. So maybe this is part of the beginning of developing a strategy, and this first green bond issue leads to more interest internally within an organization that might support creating building out more of a strategy going forward. So we do recognize not everybody's in the same place with that and doesn't have the same resources, but sort of the best practice, looking at, it's a 1 to 5 scale we're looking at. So something that would be a 5 would probably be, having a more comprehensive strategy. The second is thinking about impact assessment. So this isn't exactly having impact metrics, because we recognize that can be very difficult to have those. You have to measure something before you do the new project and after, and a lot of places don't have the resources to do that. But really this gets to the concept of additionality. So what would be business as usual if you were to just build a building without energy efficiency standards, or without, adding solar panels, or whatever it is that you're doing with this particular project? And then how is this different? So how is this different than what might have been done 5-10 years ago? And so thinking about the additionality, the additional impact that you're making because this is a green bond. And so that's really thinking about that. I've seen sometimes some places that maybe are issuing bonds that they've been issuing for 20 years, and now they're being called green bonds, but nothing different is really being done. And that's where it starts to get into that question of, is there any additionality happening here? So that definitely is something that can give a boost up in how those bonds are being assessed internally. And then the last category would just be if there is anything that is a red flag or a concern. Sometimes we've seen, an example came up in our committee, a discussion about green bonds for a prison, for example, which can be a little controversial for a strategy or a sustainability strategy, because there is controversy around prisons, and if there's an appetite for that for investors that might be interested in something that's might have social concerns there. So something like that might be a little more controversial. Not to say that there shouldn't be environmental standards and efficiencies and all kinds of things happening. It's just the nature of what that project is might make it less suitable for a sustainability strategy. And I will leave it there and turn it over to Robbie to give an issuer's perspective.
Okay. Hopefully everyone can hear me okay. So good morning. Thank you, Emily. My name is Robbie Haney. I'm the Treasury Manager at the East Bay Municipal Utility District, and we often call ourselves East Bay MUD. Go to the next slide, please. So East Bay Mud is a 100-year-old water and wastewater utility. We're located on the eastern shore of the San Francisco Bay, so in the San Francisco Bay area. Our headquarters is in Oakland, and we serve large parts of Alameda and Contra Costa counties. We have a water system and a wastewater system, so we're kind of like two utilities in one. The water system is the bigger of the two. It serves 1.4 million people. The wastewater system serves about 740,000 people. And our budget is about 1.4 billion, so that gives you some, I guess, some sense of scale. And we have about 3 billion in debt outstanding. And our ratings are AAA from S&P, and then AAA and AA1 from Moody's. That's AAA for the water and AA1 for wastewater, and then AA plus for both systems for Fitch. Next slide, please. So we've been involved with green bonds since pretty early on. We have a long history of promoting sustainability and environmental goals. Our first green bond issue was in 2015. And then since then, we've issued about 570 million in green bonds, including 2 series that we did last year. And then we're planning to do another 300 million in green bonds this coming March. So we've got more green bonds coming up. And as of now, we've done each of those green bond series as self-certification, which I'll talk a little more about. But each time we issue bonds, we've reevaluated this decision to see if we still think it makes sense. And it's been our view for now that with the sort of proper criteria and disclosure, we can give the market comfort in the projects that we're funding. And I'll talk more on the next slide about the criteria, the specific criteria. But one interesting thing is that for many years, we've issued bonds on a reimbursement basis. That means that we reimburse ourselves with bond proceeds for past capital spending. So we know exactly what projects we're financing each time we do an issuance. And we can put the details of those projects in the appendix of the OS, and we map those projects to our green bond criteria. So next slide, please. Okay, so we call it our green bond guidance, and it's our criteria for selecting the projects for green bonds. And again, these are projects where we've already spent the money because we're reimbursing ourselves. So we sort of know the menu of projects we have to choose from because they're ones we've already done, and we're applying this guidance. It was first adopted by our board in 2015. That was when we did our first green bond issue. And then most recently, it was updated and readopted in 2022 when we did our last green bond issue. The guidance maps our criteria with 3 well-known frameworks that I think have all already been mentioned: the ICMA Green Bond Principles, the UN Sustainable Development Goals, and the Climate Bond Initiative. And we're careful to say that we're not representing that we meet all aspects of all of those principles. All 3 are pretty involved, but we try to do this to provide this mapping of our criteria to this to give it some context. I guess it was our guide when we were creating it. So that's our basic approach. I can just re-summarize. We've got our board adopted green bond guidance. We apply it to projects to determine what can be funded. We're reimbursing ourselves with bonds. This might be not everyone does that. That might be a little unique to us. But that means we're removing the risk that we could use the proceeds for something else. We know we're going to use it for because we reimburse ourselves right away. We try to provide a good description of those projects in the OS and map it to our criteria. And so that has been our approach for 5 issues, and we've got, like I said, 2 more coming up. So anyway, hopefully that was helpful to hear how at least one place does it. And I think with that, I pass it on to Kevin.
Great, thank you, Robbie. My name's Kevin Savali. I'm a shareholder at Stradling, Yaka, Carlson, and Routh, and we're a prominent bond counsel firm in California and several other Western states. I have a particular expertise in federal law, federal securities law disclosure matters, and I'm disclosure counsel to lots of issuers: state of California, LAX, San Francisco, LA, Long Beach, the state iBank, city of Sacramento, and lots of smaller cities and districts. And it also represent pretty much all of the, over the years, represent pretty much all of the investment banks underwriting bonds in California. And as a result, I've done quite a few green bond transactions, probably 20 or 25 or perhaps even more. You can flip to the next slide. As you're hearing today, there's a vigorous buy side has continued to develop The conversation comes up on almost every deal because it's really interesting because I'd say probably most California bond issuances could qualify as green bonds. Certainly water, wastewater, even education facilities, public buildings, things like that. So on the buy side there, as you've heard, the institutions are devoting significant resources to analysis, and with the focus on ESG and green bonds, the SEC has heightened its focus as well. In 2021, they established a climate and ESG task force. There have been enforcement actions. The way that the SEC sort of enforces, one of its tools for enforcement is to bring enforcement actions or consent agreements. And there have been several on the corporate side relating to misleading ESG disclosure, sometimes called greenwashing. There haven't been any on the muni side yet, any enforcement actions, but it's something we have to keep our eye on. There's rulemaking currently in process for related to ESG disclosures. There's a draft rule out. The final rule is expected this year. That won't specifically apply to municipal issuers because of the general securities law framework. There's a much different rules are applicable to muni and corporate issuers. The rulemaking, the draft rule, and it's expected that the final rule on the corporate side will be very prescriptive. Just the way that the rules relating to offering documents prescriptive. It's going to tell exactly what needs to be said and the metrics that need to be utilized. As I mentioned, that won't apply specifically to muni issuers, but as always, muni issuers and the legal community, the bond counsel, always pay a lot of attention to what the SEC is thinking in connection with their corporate enforcement actions, because that, as I say, it does give us a window into how they might apply those on the muni side. We can flip to the next slide. Briefly, document considerations. Usually green bond issuances don't include enforceable contractual obligations of an issuer to adhere. So there's not a covenant in the resolution or the installment sale agreement or the indenture that says we, the issuer, agree to comply with ICMA requirements or something like that. It's more a statement of intent that's communicated in the OS and probably in your issuer resolutions, things like that. The legal documents, as all legal documents, sometimes you issue bonds, you identify a project. The legal documents allow it. For some reason there's problem with permitting, or there's cost overruns, or there's some reason that require the issuer to change gears and apply that money to a different project. You don't lose that flexibility. It's obviously not the intent, and you have to make sure that if you label something as green, that's really what you intend to do. But it doesn't lock you in if circumstances change. Your green bond, there's no specific green bond category of tax exempt financing. So whatever you do has to comply with the general rules relating to the federal tax laws. And finally, the reporting requirements may be contractual. We'll talk a little bit further in the webinar about reporting, sort of post issuance and continuing disclosure. In my experience, it's sort of, at least my impression is, it's sort of scarier than it sounds. And as we'll talk about in a little bit, insurers sort of have a lot of the information that the investors want on the shelf already. But if you do enter into a contractual requirement, as a little bit of a tip, don't put it in your 15C212 continuing disclosure undertaking and sort of get it wrapped up with the 15C212 compliance and reporting requirements and things like that. If you're going to make it contractual, which may or may not be a good idea, keep it separate from your your continuing disclosure, your typical one with the material events and annual reports and things like that. Next slide. So the basic rule of the federal securities law is that all material information must be disclosed, and information is material if there is a substantial likelihood that a reasonable investor or prospective investor would consider the information important in deciding whether or not to invest. And that's why it was really fascinating for me personally to be involved in the preparation of the guidelines and to interface with the investors, which we don't ever do as a bond lawyer, a working group. If you think about it, you have the underwriters there, but you don't really have the investors there at the table. And I've done, as I say, many green bond issuances, and oftentimes, we're struggling as a working group. What do the investors want? how much detail do they want? So it was really excellent to hear from the investors themselves what they consider important. It really was terrific guidance, I think, and I think it's easy to follow. We'll talk about that in a little bit as well. Designation description. It's okay to do certified and hire a third-party reviewer. It's okay to self-certify, but it's really important to describe the analysis used. I think that's why the East Bay Mud and Robbie's description of that was really excellent. We'll talk about that a little bit as well. And be careful to make it clear that the green bond designation doesn't affect the security for the repayment. Oftentimes the only reference to green is in the legal documents, the resolutions or the indentures, is the use of the word green, the designation itself. You don't get any as a bondholder. You don't get extra security. You don't get additional revenue streams, things like that. You don't get priority payment, and it's really important to make that clear. And there's fairly standardized market disclosures that your councils would certainly be familiar with. So it's just important. It's next slide, please. A couple of more security laws considerations. You put in some disclaimers. As I mentioned, there's not a contractual promise to build to comply with the green standards. It's a statement of intention. There's no insurance. Make it clear that there's, you might have the best intentions with respect to how well a wastewater treatment plant is going to work or how green your new headquarters is going to be, but make it clear that that's not a contractual promise to achieve specific goals. If the standards change, you make it clear that you're not commenting, you're not covenanting to keep meeting changing standards. And then describe the verifier opinion and make it clear that it's an opinion and it's not just a guarantee. And on the other side, include the second party opinion. And this is a little strong to say if you do, you own it. I probably could have had better wordings. Many times the second party opinion is included in the offering document. And part of that process is the second party, the verifier, will ask questions and will give you a form to fill out and descriptions of the project and some more granular detail. Even though that detail may not be in the OS, treat it as if the securities laws apply. It's important to be, because the verifier is going to base their opinion on the info you give them, make sure it's clear, make sure it's accurate, make sure it's transparent. It shouldn't be sort of a Chamber of Commerce view of the world. It should be actual facts. And if you do commit to post-issuance reporting, again, make sure it's accurate. It's not the place to sort of have puffery and oversell and overstate what the benefits have been. Make sure you're being clear and accurate with that and transparent. And now I will hand it over back to who? Oh, I lost track.
To me.
Back to Raul.
Okay, so wrapping up on the first goal of the webinar, which was to describe to the audience why green bonds continue to be an important topic. The best way to summarize it, I like to say, is simply green bonds, this whole discussion, whether you label or not, et cetera, it's simply a disclosure issue. That's all it is. It's just basically a hurdle of will I provide additional disclosure as to the environmental benefit of the project being financed. And that could be probably no more than a page. It could be an appendix if you have many different components, but it's just really more disclosure. And disclosure is, as a topic, is not going away. Back in March or April of this year, the SEC, the Securities and Exchange Commission, had a seminar on municipal bond disclosure. Just the general concept of municipal bond disclosure. Is it adequate? What's lacking? What needs to be improved? They had a couple of hundred participants at the conference in Washington, D.C. and through the webinar. The one comment that was voiced by many participants was, this was the first SEC seminar on municipal bond disclosure. We need more. We need more. We need more guidance from the SEC. We want more direction as to what is the disclosure that needs to be in our OSs, et cetera, et cetera. So it's definitely a hot topic. It is not going away. And again, as it relates to green bonds specifically, it is simply a question of more disclosure more project-specific disclosure on the environmental benefits of the project you're financing. On this slide, we basically show you and highlight that since 2014, over the last 10 years, there's been well over 100 billion of green bonds issued. About a third almost of that has been in the state of California, encompassing about 150 issues. And as you can see from this slide and the next slide, you'll see that there's different kinds of issuers. There's small issues, large issues, there's water districts, cities, counties, transportation entities. If we go to the next slide, I think there's a park district in here, and even the next slide. So just a sampling of how many issuers of different size, different sectors have made a conscientious decision to label their bonds green. And again, did they provide enough disclosure so that a green bond investor could buy their bond? That's subject to debate. That's the topic of this webinar. How do you make sure that if you're one of these issuers, you do provide that information and get the full benefit of issuing green bonds and attracting green bond investors? On the next slide, even more examples. I guess we could go on and on. I don't think we did all 150, but let's go to the next slide. So here we talk about why green bonds continue to be an important topic. And one of the questions that I think I will pose to Kevin and Robbie is, I know you talked about this, you just touched upon about it. And I know a lot of issuers that do issue green bonds do it in an attempt to attract more investors. There's lots of things issuers do to show investors that they are a good issuer. They get their ACFR done in time, they get it done early. They have different types of policies in place. Some of them even describe all their policies in their OS, so they're very easy to access on their website. They do multi-year budgeting. They provide multiple ratings. There's a lot of things issuers do to signal to the market, hey, you should buy our bonds. We're a very good issuer. We're taking this business of borrowing money very seriously. We're just trying to be a very good issuer. So my question is for Robbie first, and then Kevin. Robbie, the effort that you guys put forth was the example that I used early in the webinar. It is deemed to be a model by many investors in terms of the detail, the thoughtfulness. What was the driver of that? Was that staff driven? Was that a policy decision from the board? Was it a combination? What made you undertake that effort?
Yeah, good question. And I'm glad to hear it's being received well, but we're always open to improving it too. So, and it has been kind of a work in progress. I think it dates back, our green bond guidance dates back to 2015. That was before I got here, but I think it was staff driven, trying to figure out. Back at that time, that was at the early days, especially for municipal green bonds, and I think most were self-certified back then. That's my understanding. And so we were just trying to find some basis to select projects, and you know, that we could communicate with our board, and hopefully investors would like. And so it was developed back then, and hard to give us some sort of framework. We've got a bunch of projects we can potentially finance with green bonds. Most are probably green bond eligible, but we needed to, you know, put together a criteria that decided which ones specifically, and then communicate that. And then I will say, you know, as I said before, we continue to do self-certification, and we look at it each time. And you know, as of now, what we've decided, but we're always open to changing our approach, is to really just keep trying to improve the process we already have, which was to update that guidance more recently, and then put more stuff in the OS saying, hey, these projects, this is why we picked them, and try to map them to that guidance. But yeah, so I guess it was staff driven, but our board certainly appreciates, they're interested in this stuff, and they appreciate it. Allows us to have whole board meetings where we get to talk about it and go through it, or whole items at board meetings. So it's been a good experience.
Right. Well, thank you for that. Kevin, I'm going to twist my question on you just a little bit differently, because in the survey, the first survey question we had, I was actually a little surprised that the least hurdle to issuing green bonds was the lack of internal resources to provide the needed disclosure. I've always thought, in talking to different issuers of all sizes, one of the responses often is, well, that is not readily available. I have to go work with other departments to gather that data, and then work with the lawyers and the working group to, put it in proper disclosure contents. That's just an additional effort, and resources are tight. I've heard that. That was the fourth. That was the least impediment, I would say. The greater impediment was continuing disclosure. And I know you talked about this already, but on continuing disclosure, just wanted to touch on one thing. I know many investors would love annual environmental impact reports on what's going on with the entity and projects, et cetera. But in our market, the norm has become that those issuers who provide an ongoing report, the report is basically limited to the use of proceeds, how the money's being spent until the money's spent. And then once the money's spent, they say, we've expended all the proceeds on the green bond projects and we're done reporting. And then there's no additional reporting. I know many investors would like more, but that's the norm. So how much difficulty do you think that is for most issuers to track proceeds separately and provide that report? And you're on mute. I think you're on mute, Kevin.
Sorry about
Happens
that.
at every webinar.
I think it's easy for them to do in a sense because they have to report anyway for tax compliance, under their tax certificate anyway, what they're spending the proceeds on. So I think that's not the big issue. When you get further beyond that, and I think that's one of the questions later on, we'll talk about a little bit about how, there may be an annual regulatory report they have to provide. That may be sufficient. So how well, you're a wastewater treatment plant, how well are you doing meeting the criteria under your permit, things like that? Are you exceeding? And did the project that you built with the green bonds assist you doing that? So I think there's a lot on the shelf. But I would like to just respond quickly to, I think the biggest, so I've done a lot of these deals, and 99 times out of 100, the first time the concept of green bond comes up is at the kickoff meeting, which is like 3 months before the posting date of the POS. And the issuers, they got to get the OS together. They got to get that information together. They got the board. They have to get the board package together. They have to do their internal work to get the board lined up to approve. There's a lot going on. So the last thing they want to hear, at the kickoff meeting is, oh, let me add something else to your plate. So I think what East Bay Mud has done, if you're a bond issuer, presumably before you get to that kickoff meeting, you've been thinking about your bond issuance for a year or more before you actually get to the kickoff. And I think for issuers that have a sense that their stakeholders would like to issue green bonds, it's something their board would like. It's something their constituents would like. Maybe they have a rate increase coming up and it would be helpful to them in their constituency to show, hey, one of the reasons we got to raise it by 5% is because we're doing these things that are environmentally, sensitive. I think that thinking about it ahead of time, putting together a policy, and not a policy, not like a debt policy that goes on forever, a disclosure policy, limited debt policy. So then when you get to that kickoff meeting, you really have a good sense of what you're intending to do.
That's a great point, because you're right. Most bond deals take about 3 months to do from the time you say kickoff to closing. Sometimes they have to be accelerated. Rarely do they take longer than that. And oftentimes people say, whoa, we don't have time to incorporate this, et cetera. So very good feedback. I want to turn it to the investors now and go to the next slide. I talked about this earlier, but municipal investors sometimes will seek out bonds that are not even labeled as green to put in their green bond portfolio strategy, what have you. So I think that's like the biggest proof that there is such ever-growing demand for greater green bond disclosure, environmentally beneficial projects to invest in. So question to the investors is, I've often heard some investors say, we need this disclosure. And I say, why? Why do you need it? They say regulatory reasons. They say the people who give us money to invest need the data, want the data. Can you guys expand on this? Maybe I'll start with Ruth.
Yeah, so I think the answer to that is it always depends, right? It depends on who the investor is and ultimately who their clients are. Who, well, especially in the case of us here at Breckenridge that have separately managed accounts where this is their, they directly own the bonds, know what's in their portfolios as investors, and so we're obviously managing their money, and their preferences have a lot to do with what we seek to put into their portfolios and how we customize their portfolios. But I'd say, at least from our perspective, because we view green bonds as a component of getting more information on the E in ESG or environment, to be more environmentally focused. The disclosure that we get, I think more disclosure for investors, I think generally is always better. We'll never likely have enough disclosure, but as I mentioned before, for us, it's really about getting a better idea of the general approach and the commitment to thinking about environmental issues. And as Emily mentioned, so how does this use of proceeds for these green bonds fit into their overall capital plan, into their climate adaptation plan, into their sustainability plan? How is it really incorporated? Less so for us, the use of proceeds, which I think is more impactful or more important to impact investors who might be looking for specific metrics, who may be focused on green bonds as a means of disclosing specific projects so that they can track and understand the use of proceeds and how those proceeds are spent. Because you have to remember the green bond market in general has evolved out of the corporate market, where corporate issuers, they don't have the sort of same regulatory guidelines as the muni market does, where they have to give specific information on the use of proceeds, just generally speaking, when they go to voters to get these bond issues approved. And on the corporate side, they can issue general corporate bonds and use that money for whatever that the corporation needs. But green bonds really, as a concept, evolved out of that approach, so that the proceeds of those green bonds would only be used for green projects, and they had to prove that was the case. Whereas in the muni market, it's a bit different. And so I think, when you think about green bonds, I think the typical investor or historically the typical investor had been more on the impact side. Whereas I think in the muni market, because municipalities and what they're using those bond proceeds for really align so well with green bonds, which is what we've said, practically in most cases, most things that issuers are issuing bond for, could well be labeled either green or social, because they have a green or social impact. And so for us, though, as integration investors, it's really more about sort of the broad picture.
Got it. Emily?
Yeah, I would just add, I think it's those of us who are looking at the bonds are analysts, so by our nature, we don't take things at face value. So we want to dig under the hood. We want to see, or look under the hood. We want to see what it is that you're actually doing. And so if you're just telling us it's green, but we're not being given any data or information about that, it's hard for us to really categorize it that way. And so, the more information that you can give us in that, the more we can look at these as something that's actually a green bond. And I do think I kind of mentioned this earlier, but you can improve over time. So you might start out, and I think Robbie just kind of mentioned that they're starting to add more, more information. And I imagine it's maybe evolved over time since 2015. So maybe you start the first year and you don't have all of the data, but you get feedback from investors or bond counsel or your underwriter or somebody, and then the next time you issue bonds, you're adding more and more to it. So I think it doesn't have to be a hurdle that we can't do it unless we have everything all at once. You can start small and then keep adding to it over time. And so maybe the first year there's not quite as many investors that find it up to their standards, but you get that feedback and you can add more to it and come back the next time around.
God, I think that is such an important highlight. I hope people take that away as one of the takeaways from this webinar. It's not all or none. It's like we showed you an example at the beginning of the webinar of just the one sentence versus the East Bay mud example. You could be somewhere in the middle and just progress over time. But I think the key takeaway is you don't have to do it all in your first issue. You just need to do a little bit more than that less than ideal example, and then kind of work from there. If we could go to the next slide, I'd just like to summarize our goal two, I should say, of demonstrating benefits for issuing green bonds. Clearly, a lot of people, issuers, do lots of things to try to improve better pricing. They get more than one rating. Sometimes they even have 3. They try to get their act for early. They put quarterly budget reports out there. They have easy to use investor websites where the investors can go to the website and look at quarterly updates, budgets, ACFRs, their policies, etc. Some of them have sustainability websites where you have all this great ESG related documentation, and all of that requires effort. So I think a lot of the times when people issue green bonds and try to improve their disclosure, they're doing so conscientiously to try to increase demand for the bonds and get a better pricing. I think secondly, clearly I've heard this from investors across the board for many years, that they do look for signals where strong management is present. They have policies in place, there's actions they take, multi-year budgeting, et cetera, whatever it is that shows that they have a strong management. And this would be another example to signal that to investors. The third one I think is really important, because a lot of the time, as I think Kevin alluded to earlier, but you're already doing a lot of this work. It's already, the information is within the organization. When you decided to build a LEED certified building, there was an effort to get that certification. And all we're asking is for you to put some of that information in the official statement. So, you know, third and fourth comment, why not get credit for the work you're already doing? Why not show leadership to your employees, the residents, the taxpayers, that you're being a leader in environmental stewardship efforts? And issuing green bonds is a good way. And then maybe, who knows, but maybe the local press will even write a good story about you in the local paper. Any other thoughts from the panelists on the benefits of issuing green bonds?
Yeah, I would just add, so on the question of pricing, I know this always comes up every time green bonds are talked about. So what we have heard from our portfolio management is, you know, on the taxable side, there does tend to be a 3 to 5 basis point difference. And part of why that is there's greater demand from Europe and from other countries where there's a need for, from a regulatory perspective, there may be a greater need for something that's, and this is typically if something is labeled green bonds. I don't know if the same benefit has come when it's been self-certified. Robbie might be able to speak to what they've seen more on the tax exempt side. But this summer, there was a paper presented. Brookings has a municipal finance conference, and there are some researchers from the University of Florida that presented a paper that they saw since 2018 some green EM on the tax exempt side, so lower yields of about 2.3 basis points on average. So there is starting to be some research out there. I haven't independently verified it, but if you look at the Brookings website, you could find the paper. But we are starting to hear more discussion around that. And then the other benefit I would say is just, you know, kind of to, Kevin talked about, you know, when people are showing up 3 months ahead of time before issuing the debt and talking about adding the green bonds label, you know, I think it also, what we're often looking for is that this is kind of becoming, you know, endemic to everything about what you're doing as an organization, especially being in California, if you're working towards those net zero goals, that it's less about the green bonds and more about the green project. And so that these projects are moving in the direction of becoming, so that, you know, we've kind of talked about this a bit, but that every municipal bond really is a green bond. So it's not actually then a big cumbersome process to issue this. It's more, as you're saying, Raul, just doing the work you're already doing in making these projects more sustainable, more energy efficient, and and then just telling that story in your official statement. So I think it's the other benefit I would add is just sort of adding to that momentum of moving forward on those initiatives, and maybe providing leadership not just within your organization but within the municipal market and to other communities that might then take from there and continue based on the example that you're setting. So I think there's a lot in continuing the momentum of working towards those goals, that by bringing your story to light and issuing something as a green bond, you're supporting those initiatives as well.
So I would just say, I think I read something that you wrote a couple of years ago, maybe, Emily, and one of the takeaways I took from that research piece was you said, stop talking about green bonds, start talking about green projects. And really, that's what it's all about. You're working on green projects, you're building green projects, tell us about it. That's what we're talking about here. So let's go to the next slide in the interest of time. I think we're approaching our minute. We have a survey question number 2. Let's see who was paying attention here, but just kidding. Question number 2 is, which is the most critical attribute of a green bond? Number 1 is that the municipal issuer labels the bond green. A third is that there is a third-party affirmation of the bond's green label. Or thirdly, that the proceeds fund projects with an environmental benefit. So I think we give you guys about 60 seconds or thereabouts to provide your answer. Click away. We need music in the background as people are voting. I think we're tallying the results. And holy smokes. So basically 97% of the audience got an A on this exam. Thank you for being so attentive. We really appreciate it. Again, it is simply describing how your project meets some established green bond criteria. What are the environmental benefits? That's really all that's needed to make sure that your bond is deemed green by investors. So thank you for being so attentive. Next slide, please. So our third goal was to kind of give the audience an understanding that not all municipal bond investors are the same. They come in different sizes, they have different investment strategies, they have all different internal criteria, different disclosure needs, if you will. Some of them require very specific environmental project disclosure with metrics on impact, and some of them are happy with just more general environmental benefit discussion and how you're approaching these challenges. So it runs the gamut. On the next slide, we basically describe 4 types of investors, loosely based on the category of how the Securities and Exchange Commission, the SEC, how they label investors. So I'm going to ask Emily and Ruth, and I'll start with Emily, if you could just randomly pick 2 of these and describe the type of investors, please.
Sure. So I'll just start with the first 2, the green focused and impact investors. There's some overlap between these 2, but green focused would be investors that are specifically seeking out environmental projects. So it might be, we have some investors who are just really passionate about climate change or really passionate about environmental issues. And so they specifically want to invest in those kind of projects. And so they would be looking for green bonds. And that could be a fund, or it could be, Ruth talked about separately managed accounts. So these are individuals who are investing specifically in municipal bonds who, maybe this is the most important thing to them. And then impact investors are looking, this is where kind of that issue of meeting very specific metrics can come into play. And impact investors might invest in some municipal bonds, but often can invest in other types of projects as well. But they're really wanting more specific measurables that we don't often find within municipal green bonds. I don't know that I've ever seen true impact metrics being provided. I don't know, Ruth, if you have, but But typically it's because it's very difficult and it can be expensive to assess these. I guess maybe DC Water did do municipal impact bonds. That might be the closest we've seen to something like this in this space. But that would be someone who's really wanting very specific metrics there.
Yeah, I would echo that. I don't think I've seen like true sort of European definition impact issuance in the muni side. Probably DC Water is the closest I've seen as well, and that was a very small issuance if I'm remembering. But I'll cover the integration and the traditional. The traditional is probably what what most of us think of as sort of our rating agency traditional credit analysis. There's not really a specific environmental mandate. They may incorporate some environmental risks, but not sort of following more of what we've seen over the past few decades. In terms of integration, that's what I was focusing on before. It's what we do here at Breckenridge, where we're not truly focused on the use of proceeds, but rather thinking about the issuer holistically and and the environmental impacts on that issuer and how that could impact overall credit risk over a longer term horizon.
And one of the things that I've heard and I've read a lot about is this intergenerational transfer of wealth. And the way I've read about it and people have talked about it is, it used to be that the investor was a patriarch. He came in and said, "What's my rate of return against the benchmark?" And now we see a generational transfer of wealth into the younger generations, the millennials, et cetera. You have more women at the table. You have younger people at the table that are basically saying, not only what's my rate of return versus the benchmark, what am I invested in? Tell me more about it. So it's really, that's really driving the growth in green focused strategies and funds. And then I remember once I asked an investor, I said, why do you need a better project disclosure for regulatory purposes? And the answer was, well, if we tell somebody we have a green strategy or what have you, or a green fund or what have you, the regulators are going to say, prove that. What criteria did you use? How did that bond meet that criteria so that you're telling that your ultimate investor that you're meeting that investment strategy that you said you are? So where is it? And that disclosure is so important to be able to prove that your bond meets their criteria and therefore it's in that portfolio fund strategy, whatever it is. So with that, I'm going to go to the next slide, which is the topic of external review. And we kind of had a discussion, what are these things called? Are they called third-party verification reports, second-party opinions? I mean, it's basically an external review. And I think across the board, I think if you ask investors, they'll tell you that the most important thing that they need when they invest in a green bond is project-specific disclosure on the environmental benefits of the project being financed. So the disclosure is paramount to everything. I also gave an example about a green bond investor buying a non-labeled green bond just because it met their criteria. They just needed a little bit of information. So, and then Robbie talked about their approach, setting up their own criteria, their own policies to give investors comfort. That said, there are investors who do prefer a third-party review affirmation, if you will. And maybe I could ask Emily and Ruth just to chime in on that. How important is it for each of you in the context of investing in that green bond?
I would just say it really depends on which strategy it's going into. So we have, many where it doesn't matter if it's a green bond or not a green bond. We're going to look at what the use of proceeds are and make our own determination. Somewhere it's perfectly fine if it's self-certified, but there are, especially I kind of mentioned before, European investors. There are other parts around the world where there is more regulatory concern that requires having more certifications. So if it's with an investor who's needing more certifications, then that I think is important. My understanding from our portfolio management team is, if something doesn't have that certification, it's generally, at least on the taxable side, trading the same way it would if it was labeled or not green bonds. So there is some perceived benefit from having it.
Yeah, I would echo what Emily says. I think it does increase outside transparency and can open up the possibility of foreign investors who may have this as a qualification. But at least from our perspective at Breckenridge, we don't require it. We don't put any more or less weight on it, so long as the individual issuer is providing that information. But from our perspective, so long as the disclosure is robust, and we can get our own our own information from it, from our own analysis, and don't really need an issuer to pay for a third party opinion.
Yeah, and I would just say, if the cost of a external review is going to prevent you from issuing green bonds, then please don't feel like that's a necessity. You can just provide the additional project specific information. The flip side of that, I would say, if you're issuing a larger issue, the cost is so nominal that I think if having that external review brings in an additional investor 2 or 3 more demand for your bond, it probably pays for itself. So especially for the larger issuers, I don't think it hurts. It's also a way to signal to the market, hey, we're taking this process seriously. But again, not necessary, totally on a case-by-case basis. But I think this is very good input.
Yeah, I would add that, as an investor, it does make my job a bit easier because, all the information is collected in that one place. Yeah. It just makes it quicker and faster and more user-friendly. But
yeah. Okay, so with that, thank you for that input. Let's move on to our third survey question. And so what type of investors will purchase green bonds? And we'll give you about a minute. Your choices are green bond focused investors, impact investors, integration investors, traditional muni investors, or all of the above. And again, we'll give you just shy of a minute to chime in and vote. I see that we're tabulating the results. Let's see how well we do here. Okay, the results. Oh my gosh, 100%. Robert, I don't know if you've ever had such an attentive audience in another CDAC webinar, but this is really impressive. Everyone got it right. So thank you for being so attentive, audience. We'll move on to the next section, which is our final section. Perhaps the most important, what information is it that investors want to see in the official statement? And we point out, and we just start off by saying there are some other frameworks. I referenced them earlier. There is the International Capital Market Association, or ICMA's Green Bond Principles. That is the most commonly used framework. So what I and some of my colleagues did is we looked at all the green bonds issued nationally in 2022, looked at every OS, and then tried to determine what criteria did they reference. And 74% referenced the ICMA Green Bond Principles. So clearly, it is the most frequently used framework in the municipal green bond market. There's also the Climate Bond Initiatives, which is largely based on ICMA's framework, takes it to another level, utilizing standards to show consistency with global climate goals. And that was less frequently used. I would say that was definitely used by the larger issuers, a lot of the utilities, and who have very detailed plans, with global climate goals. So let's just focus on the ICMA green bond principles. If we go to the next slide. So this graphic really shows the fundamental framework for ICMA, which is basically 4 steps. And really this is kind of the minimal, if you will, the baseline of information that investors would love to see in the official statement. Tell us how you're going to use the proceeds. What projects are you going to spend the money on? Secondly, how did you deem these projects to be environmentally beneficial? How did you deem them to be green? What criteria did you use? It could be ICMA, it could be CBI, it could be your own. What criteria did you use to evaluate that these components would meet and produce an environmental benefit? Number 3, how are you going to manage the proceeds? And this is kind of a very important one, because another reason that people tell me, well, I can't really issue green bonds because I want flexibility. I'm not just building a single project. I've got 10, 20, 30 components, and what if it changes? And I always say, you have flexibility. The pool of projects can change, but if you tell the investor, I'm going to spend 100 million proceeds in environmentally friendly projects, and these are them, if they need to change, if they are going to change, the replacement projects have to meet that environmental benefit. So you said there were going to be green projects. You should spend all of your proceeds on green projects. If they change, you got to let the investors know. And again, when it comes to reporting in our market, the general consensus, the standard, if you will, is we will produce an annual report to the investor that basically says, this is how we're spending the money. And once all the bond proceeds are expended, you stop reporting. So it's kind of really, I don't want to say it's that easy, but those are the 4 fundamental steps when it comes to issuing green bonds and what needs to be in the OS. If you go to the next slide. So in our paper, again, that you could access on the CDAC website, we basically said, okay, let's look at 4 sectors. And we know there's more sectors than these sectors that we have here, green bonds, green buildings, water, transportation, and power. But we said, okay, let's say we have an issuer who wants to take it to another level and provide impact metrics. This is really important for that growing universe of investors that need impact metrics. Not only, don't just tell me generally that you're going to use less water, that you're going to recycle water, that you're going to have solar energy, but can you give me the metrics? Like, could you actually tell me and quantify what the expected benefits are in whatever sector we're talking about here? So our paper has these 4 sectors, and if you just go down one slide, and we're going to come back to this one, but I just want to show you, this is just a subset, right? So this is our metrics for green buildings. Go to the next slide. For water, next slide. Water had 2 pages. There's a lot there. So there's a lot of metrics here. We'll go one more and then go to transportation. And then I'm going to ask you, Anna, if you could go back to that summary slide where we have all 4 components. I just want to give you a flavor. There's a lot of stuff. And what Emily said earlier is really the one of the great takeaways. While we listed a lot of metrics and data and information that we would like to know about each project, it's not all or none. If you say, I don't have all this information, that's okay. If you say, well, I could produce half of this, I could produce a third of it, that's okay. That's more than what investors are getting today, by and large. So to the extent that some of this data is available, and you could augment your project description on environmental benefits with some very specific impact metrics, I think many investors would be very, very interested in your bond deal, and hopefully you'd have greater demand, et cetera, et cetera. So I really don't want to go into great detail on this. This is something people could review depending on your sector as you read the paper, as you get a copy of this presentation. Anything from the panel on this section that you guys want to augment? Okay, thank you, because that kind of puts us really close to our final survey question. We could just go all the way. We're right on time if we go to the final survey question. And the final survey question is, what is most important to ensure investors treat green bonds as green? And 3 choices: secure a third-party verification report, secure a second-party opinion. Again, that's just synonymous in my mind. They're both an external review. Or thirdly, disclose project-specific environmental benefits. And I think people are voting. We'll give you a few seconds here. And we're telling the results. This is your final question. You guys are doing so well, 97%, 100%, very impressed. Should have the answer here. And 97%. So clearly the whole theme of our discussion has been just provide as much project-specific disclosure about the environmental benefit to the project, and that will make investors very happy, interested in your bonds. Robert, I think we're right on the money at the 90-minute mark. So I think with that, I'm going to turn it back to you and thank all of our audience for being on, and thank you so much to the panelists. And Robert, back to you.
Thanks, Raul. Let's see if we can, if folks won't mind hanging in for just a couple of minutes longer here. Let's see if we can, there's a couple of questions and I'll pose them to the group. For the investors, Ruth and Emily, are there third-party data service providers that buyers look to in performing their green analysis in addition to second-party opinions in the OS?
There isn't anyone that we use or that I'm aware of. Ruth, I don't know about you.
No, no one specific.
Yeah, I know there's some like Bloomberg listed on there, but we're not relying on that for our analysis.
And this is a question specifically to Robbie. So this is from a fellow issuer. We've raised the question of the use of proceeds, objectives, and key results akin to key performance indicators related to green financed assets. Are you seeing or are you being drawn to structuring a form of performance indicator beyond the exhaustion of bond proceeds, the measurable impacts post-expenditure proceeds?
Well, I think I follow. It sounds like maybe these are KPIs on their projects in general, whether or not they were financed by bonds. Anyway, if I'm right at all, it sounds like that's a real integration of their capital planning and green projects in general. And that sounds. If I have that right, that sounds great, and something to that might be a further step for us to think about. I mean, we have so many things we do beyond green bonds to think about sustainability policies and such. This is very important to our board. So a lot of the projects we do qualify, but that sounds like even more proactive. Maybe if like with every project you're thinking about the potential for green bonds, even if you don't know whether or not you're going to finance that with green bonds. Again, I may not be fully understanding it, but that sounds like an innovative approach. Sounds good.
Thanks, Robbie. And then a final question quickly here for Kevin. Any thoughts on whether there's any more regulatory exposure for an issuer in self-certifying versus external certification?
Generally, no, but there is an element. If you get a third-party report that sort of, the same way you have audited financials, it's sort of referred to as expertizing. So the fact that you're having a third party come in and weigh, I would say, reasonably provides you a little bit more cover than self-certifying. You have to be more careful. I think that's a true statement. Now, does that mean you have to certify? No, I think there's ways to get there with self-certification, but I think is a fair point, expertizing sort of anything, like when you bring in a, consulting engineer to express an opinion on the reasonableness of your construction schedule. It's the same sort of thing. So expertizing definitely can help.
All right, well, thank you, Kevin. Okay, that'll close out our program. We're out of time here. But before we sign off, first, just a huge thank you to Kevin Savali, Ruth Decret, Emily Robert, Robbie Haney, and Raul Amezcua for your hard work preparing the presentation today, and for your work outside this program in educating the issuing community on green bond disclosure approaches. Before we sign off, I'd like to quickly draw your attention to an upcoming CDAC program on October 19th. CDAC will present the pre-conference to the Bond Buyer California Public Finance Conference in San Francisco. We have a terrific group of underwriters, advisors, and issuers that will be talking about managing borrowing costs in the current market conditions. Full program and registration information is on our website now. And then finally, we'd like to get your feedback about this session. Please spend just a few minutes when you receive our post-program survey and tell us what you think. It's all very helpful and appreciated by all of us. On behalf of our presenters and all of us here at CDAC, including our education team, Angela Ayala and Anna Ramirez working behind the scenes here, thank you all very much for joining us and have a great day.